Hey guys, Tex here. Welcome back to the channel. Today's Friday, April 29th. We are wrapping up the week and closing out a month. So we have a lot to talk about in this weekend's video. So let's just go ahead and roll that intro and get started. All right, guys, so welcome back. What a way to end the week and the month. In case you guys missed it, I have been posting just the past few days. I started to post kind of regularly here on my Instagram account, just some of these short videos, my thoughts on the market and actually talking about some of the trades that I've been taking, especially on the S&P 500. So if you guys are interested, you can follow me. It's Tex_trading over on Instagram. I also posted a YouTube short, and I got some feedback. I guess you guys did enjoy that, but I wasn't sure if you guys, really cared to see my YouTube channel get all cluttered up with a bunch of short videos. Kind of felt like Instagram would be a better platform for that, but let me know in the comments below if you guys are interested in those short kind of videos and whether you use Instagram or not, and if you'd rather see them on YouTube or both or whatever the case may be. So with that said, guys, let's start out here with the S&P 500 as we always do, and I'm going to go ahead and blow up this weekly chart, and I don't want to spend too much time on this because I have talked about it several times now in a couple of my recent videos, but my thesis so far is playing out perfectly, really. I'm expecting newer lows here, and right now we're seeing that price action continue to play out. Now, I mentioned we have this big volume pocket right here, and typically when you get price that falls inside of a volume pocket like that, it tends to fall through it pretty quickly. So the first area where the volume starts to come back in is around 3,900. There's also a technical level there around 3,914 that I have marked up here from the weekly chart. The other thing that I did is I drew a Fibonacci price extension, and let me just show you this really quickly. If we can grab this chart in the right spot, let me just delete this and I'll redraw it for you. So if you're not familiar how you can use this tool, make sure snap mode is turned on. Yes, it is. And let's grab, it's called Fibonacci price extension lines. And the way this works is we want to kind of capture this downtrend and give us a mathematical projection of where price could be going if that trend were to continue. Because when you have a downtrend, a lot of times what you'll see is you'll have a move down like this, and then you'll have a bounce, and then this measured move down here is the same distance you'd look for the next leg down, right? So if you were to measure this move down and project that over here for the next leg down, you can get a mathematical projection of what that should look like. So you use that Fibonacci price extension. We go from the all-time high to the low of the pullback, then you take it up to the lower high, and you snap it just like that. So now you can see that it has projected that 100% move, measuring this, 100% of that same move brings you down to 39.33, and look how nicely that is lining up right there with that weekly level at 39.14. Okay, so that's an interesting tool that you can use. Obviously, it's just one piece of the puzzle. It's not it's not necessarily a buy signal or anything like that on its own, but it is interesting nevertheless to use a tool like that. So I love how we have both math and technicals lining up with that 3,900 level. And I also love that a move through this big volume pocket would bring us down into the next area of volume interest there. Now, I think ultimately that probably won't be the bottom of the market. It could be, of course. We always want to be looking for bottoming signs when we come into these key levels like that. But I think more realistically, the bottom of the market is going to be closer to 35 to 3,400. We have a prior all-time high back here, which was just before the COVID sell-off here. So, of course, we could retest that all-time high. That's kind of closer to that 3,400 number. And then the level I actually have marked on the weekly there is 3,441. The other thing that we can do is just take a standard Fibonacci. We're going to go from that pandemic low to the all-time high. And if we measure that out, you can see that a 50% retracement from the low of the pandemic to our all-time high would also bring us into that 3,500 level. So I think that more realistic areas to start looking for, a real long-term bottom in the market is going to be somewhere in this area. Okay, so we'll, of course, have to see what it looks like when we get there. I don't think that's going to happen very quickly. I think it could be some time. If you were to measure this out in terms of percentage from all-time high all the way down to that 3,500 area, that's roughly about a 30% drop from all-time highs. So in terms of percentage, if you want to define a bear market, it is 20%. So any time an index or a stock drops below 20%, it's considered in a bear market. And I believe the NASDAQ has already dropped 20%. So technically the NASDAQ is already in a bear market or very close to it. The S&P hasn't quite fallen 20%, so it still has some room to go. Again, that's just the technical definition of it. But in terms of the trend, we're in a bear market, guys. We are pulling back. So I think that, we'll start looking at these key levels, 3,900 first. You got the 38.2 retracement around that 38. So anywhere between 39 to 3,800 is going to be probably a pretty important area to start looking, at least for a short-term bottom, if anything else. If we come over here to our daily chart, I have these levels around 40.34 and 40.20 marked up just because that's an unfilled gap here on the daily. Now, I don't necessarily think that that's going to be, like I said, a long-term bottom or anything, but I think on an intraday basis, it would be a level of interest to pay attention to. Obviously, things don't go straight down. You have down days and then you get bounces. And in fact, you get some of the best bounces you could ever trade in a bear market when you get these incredible, rip your face off rallies like we saw yesterday. And part of that comes from people being over leveraged in puts. And when you start having key levels broken to the upside, all those puts that the market makers had to sell to, investors and traders and whatever the case may be, has them, they're in a situation where they have to start hedging, and that can cause forced buying. And then you have shorts getting squeezed out of their position and they're tripping over each other trying to cover their position. Then you have the bulls coming in thinking, the bottom's in and they're going to start buying, and it just creates this buying frenzy. Like we saw back here on Thursday. I mean, look at this: 1, 2, 3, 4, 5, 6, 7, 8 consecutive green 5-minute candles that literally opened at the low and closed at the high with 0 pullbacks. Okay, that's the kind of rip your face off rallies that you can get in a short, in a bear market, because of that, that imbalance of people being leveraged too much into puts, and then the market makers having to basically, start hedging positions as key levels of the upside get broken. And these can be very lucrative if you can, pay attention to where we are in the bigger picture here. Let's fix this chart. Pay attention to where we are in the bigger picture here, and knowing that the market is coming into a key level of support, and then also coming over and looking at things like the VIX, right? And when you see this on a weekly chart, it's not that often that the VIX gets above, 37 to 40, right? This right here was in the pandemic, right? We saw, I think, like 85 was the high. That's just insane, right? That's not normal. That doesn't happen that often. You can see clearly by looking at this chart, every time it gets up into this 37 to this 40 level, it wicks and it falls, right? So we're pushing up towards that area now. It doesn't mean that we can't break over. We certainly can break over, but it's just something to pay attention to. It's another kind of piece of the puzzle, right? If you have the market coming into a key support area, like for example, that 3,900 area, and you have the VIX kind of up here around that 3740 area, or maybe even a little bit higher, you know that there's a lot of people buying puts. And you also know that when the market does kind of reverse, even if it's short term, all of those market makers that are selling those puts, they're going to have to start hedging. They're going to have to start buying. And it's going to create those rip your face off rallies. And you want to be able to position yourself, to be able to capture those. So that's what it looks like here in the S&P 500. Let's just bounce over here really quickly and take a look at the 4-hour charts here on the futures. So I've got the S&P E-mini futures mapped out pretty well. You can see that we're coming into the close here into my first level of 41.24. To the downside, we have 40.40. And then probably more lined up with the S&P cash index is going to be 39.28 would be the real area of support that I'd be looking for. In fact, let me just go ahead and make that line blue so it stands out for me. The S&P futures is off by about 8 to 10 points, I think, from the actual cash index. It's usually about 8 to 10 points cheaper. So if this is 39.28, that means the S&P cash index, we'd probably be looking at somewhere around 39.18, maybe 39.20, something like that. So if we go back over here, 39.20, yeah, I mean, look at that. The support on the S&P weekly chart is 39.14, and if we go look at the S&P futures, it's 39.28. So it's in that neighborhood. It's in that neighborhood. So I think that's realistically where we're going before we find kind of another bottom for maybe a short-term bounce, and then maybe even new lows after that. We will see. On the NASDAQ, of course, that one is incredibly weak, though, compared to the S&P because it is so tech heavy and so many growth names in that index that have just been destroyed, obviously. So that one I don't have mapped out as well, but somewhere around the 12.3 area is the next area of interest. And then if things get really ugly, maybe even all the way down to 11,000 on that index. But as you can see, very clear downtrends in all four of the indices. You got the S&P here, the NASDAQ here, you got the Dow here setting new lows, the Russell 2000 as well. Of course, your small caps, this is definitely going to be your risk on type of index here, and clearly it is not risk on time. It is definitely downtrending and setting new lows as well. Then we just have oil and gold over here, just kind of keep an eye on the bigger picture of what's going on there. Now let's hop over and take a look at the sectors and kind of get a little bit of a granular view on this. And since we have closed a month out, let's switch this over to monthly charts. Now, with the exception of the semiconductors here, the rest of the sectors I have sorted in terms of their weight in the index. So starting here with technology, then you got healthcare, consumer discretionary. Technology, for example, is your heaviest weighted sector in the index. Of course, that's going to have your companies like, Apple and Microsoft, right? These stocks have such large market capitalizations that they can really drive the market by themselves, so to speak. So when you have those stocks, being incredibly weak, it can really drag the rest of the index down, even though you maybe have defensive type sectors that are holding up. But when we look at this monthly chart, we're actually not really seeing that. Look at semiconductors here, big monthly bar breaking down below all of your moving averages there. Tech as well breaking down below the 9 and the 20. Healthcare typically could be seen as a defensive sector. It did have a pretty stiff rejection monthly bar here down towards the bottom of that consolidation area, but holding up certainly better than tech and semiconductors. Consumer discretionary, these are going to be your Teslas and your Amazons, both of which got destroyed this week. So, of course, you have this big breakdown weekly bar here, really kind of hovering down near the lows from the past 2 months, but obviously a strong monthly bar closing below the 9 and the 20 there. Communications, this is your Google and your Facebook. I think even Disney is in that sector. Obviously, you can see just incredible weakness there. Look at that huge breakdown on that monthly bar. Financials, again, self-explanatory there. Industrials, consumer staples, another one of your defensive sectors. These are obviously your Coca-Colas and your defensive type stocks that people tend to try to hide in downturns in the market. These are like your dividend paying stocks. So no surprise to see that it actually closed a green month, although barely. No surprise to see that, there's some relative strength there compared to the rest of the sectors, but it's hard to call that really strength. Utilities, another kind of defensive sector, again, showing some weakness even there, but above the moving averages. You have real estate, basic materials, and then energy. Of course, energy being driven by other factors across the globe. But when you look at this bigger picture on the monthly chart, what are we seeing, right? We're seeing significant breakdowns in just about every single sector. And when you see this, that tells me that, we're in a situation where there's just not a bid in the market. And so this is really further supporting the thesis of lower prices. Now, it's not going to happen all at once, but obviously, this just looks very bad for the market. Taking a look at the internals really quickly again, we talked about the VIX. I found this interesting. If anybody knows why this happened, let me know in the comments below. But we got this incredibly crazy reading here on the VOLT SPD. This was on the 18th of this month. I have never seen a reading like this. Look at this negative reading that came in here. I don't know if this was a bug or whatever, but it still remains here on the platform. I've never seen that before. That was quite interesting to see that. But overall, you can see how many of these days where we just have this incredible volume selling pressure to the downside. So everything, the sectors, the indices charts, the internals, and when you start really looking through individual stocks, everything is pointing to lower prices, okay? Now let's just wrap up by going over here and just taking a look at a few stocks. I want to start out here with Apple. I really don't trade Apple anymore, but this is just something that I do want to look at because it is, I believe, Apple, Microsoft, I don't know in which order, I think it's Apple, is the largest market capitalization. And this stock in particular has so much much market cap that it matters what this stock is doing for the overall index. It's held up relatively well compared to some of the other tech and growth names. I mean, you can see that this monthly bar did have a breakdown closing below the 9, but above all of the prior months lows, right? So it's held up incredibly well. This is one of the stocks that I sold all of my long-term holdings in. All of the names that I picked up, the tech names and things that I picked up after COVID, for example, Apple, Microsoft, Nvidia, Amazon, Google. I sold all of my shares in all of those companies because I think that we're going to see lower prices, and I think we're going to have a really good shopping opportunity. So I think this is a good time for you guys to start getting prepared for this. You know, start making a list of the stocks that you want to buy and the levels that you're interested in buying them, and put your orders out. You know, put your orders out at those price levels that you're interested in buying, and just wait and let them get hit. That's really how you're going to get the best fills that you possibly can. So if we take a look at the weekly chart here on Apple, obviously there's a massive volume node here around that 120 area. If this thing could ever pull back to 120, I would definitely pick up some more shares of this. Like I said, I sold everything I have in the name, but I would love to buy it again. It's Apple, and you know, it's kind of one of those stocks that probably should never sell, but I was, you know, up so big on it after the low from the pandemic that, you know, I had to take some profits. And so that's where we are. 120 would be great if we could get it on Apple, but look at the relative strength on this name compared to some of the others we're going to look at. So let's take a look at here at AMD. Look at this big monthly bar breaking down here. We are kind of coming into a level of interest here around $80. Let's look at it here on the weekly. So you can see the clear volume node coming in here. And then my weekly level is 78. Now here's the problem with this, guys. I do like this. I like the amount of volume here. I like this level here on the weekly, but it is not time. It's not coming into that level. You know, it's not timed with the market. Okay. What I mean by that is the market, the S&P and the NASDAQ look like they're nowhere near a bottom. Okay, where AMD is coming into a very interesting level that I wouldn't mind considering buying some shares. But if the market is going to sell off further, then it's going to be really difficult for this stock to really catch a bid, a significant bid, and find a bottom. Okay, so I think the better play is going to be to look for those bottoming signs in the market. But this is definitely an area of interest, if anything, to possibly trade off of that 78 to 80 level. But look at this big volume pocket here, right? If we break through that, things could really fall apart. And we'd be looking closer to 60, maybe $50. Here's another volume node down there. So I'd keep an eye on it. I mean, maybe trade it all around that 80 level if there is some type of support there. But you can see it's obviously had a nice breakdown here on the weekly. It might need to consolidate around this area, which is most likely. You know, you can see how we consolidate here, another leg down, maybe another area of consolidation, another leg down, and then we look for that long-term buy somewhere around you know, the $50 level or something like that. But this is one I want to keep an eye on. I don't think it's quite ready. Amazon just absolutely got destroyed after their earnings. Obviously, you can see trading back down around 2,500. The level that I'm most interested in on Amazon is down around 2,000. That lines up on the monthly, the weekly, and the daily. So if Amazon can get down to around 2,000, that's an area of interest where I would look at picking up some shares. Let's go take a look at Google. This is another one I would love to pick up some shares on, but I don't think it's anywhere near the target yet. Look at this big breakdown bar here on the monthly. Let's go over here to the weekly on this one. There's a lot of volume pockets here, actually. We're coming up to a new volume pocket here that's going to bring us down around 2050 area. Then another big volume pocket brings you down around 1,700. Now, I think this stock actually has a stock split coming up here in the near future, so these prices will change when that happens. But as of right now, the drool zone dip buy is going to be closer down here to 1,700. But first area of interest, probably around 2,000 on that one as well. Again, I just want to monitor these with the overall market and look for those bottoming signs when they come in. Microsoft is another one of those very heavy weighted stocks in the entire index, similar to Apple. Look at this incredible strength here. They're doing everything they can to hold this stock up. If this thing gets a nice pullback here, let's take a look at the weekly. Massive volume node down here around 215 or so. Would love to pick up some more shares of Microsoft if we can get down there to 215. It's not one I trade, but definitely want to keep an eye on that for long-term investment ideas. Nvidia is one that I trade, but I also want to pick some more shares up if we ever get a decent pullback here in that name as well. Look at the nice consolidation down here around 130. Let's take a look at it here on the weekly. So we're kind of coming into my first area of interest here on the weekly around that 178 level. Again, it's not really timed with the market. You can see the volume pocket here. I think that this could really continue to fall lower, maybe more like 150. Your volume node comes in a little bit underneath of that. So, I think that probably this thing's going to need to pull back quite a bit more before I'm interested in picking up some shares long term. But we could find some areas of consolidation to trade off of here and there. So we'll keep an eye on that one. And I guess last but not least is Tesla. This one just got destroyed this week, and Elon Musk obviously sold something like $4 billion worth of shares. That was a pretty crazy day. It just sold off for like 2 hours straight and it didn't even bounce. Relatively speaking, though, I mean, this stock has held up well compared to some of the other growth names and whatnot out there in the market. This is definitely one that I would like to get back in. I sold all of my Tesla shares. If we could see Tesla get all the way back down to that 400 area, maybe. But this one actually has some crazy stock split coming up, so not a big fan of that. I mean, all of our favorite stocks we like to trade are just getting destroyed. You're just running out of good names to trade that have good ranges, so that's why I've been really kind of focusing on trading the S&P 500 cash index. So that's where we are right now, just kind of roughly going over a shopping list of things that I'm going to be looking at as the market sells off further and maybe finds a bottom, and where we are in the overall bigger picture. Like I said, guys, I think we're going to see lower prices. As far as Monday goes, we're of course going to have to wait and see where we open up. The low here from the February sell-off was right around that 41.15 level. It's technically 41.1465. If we gap down underneath of that on Monday and we get any kind of a pop-up into that area, that could be an area of interest for a short. If we get too big of a gap, though, guys, I think there's a good chance it won't bounce at all. We'll just see it just completely fall apart. Again, that would be inside of that volume pocket that we talked about here in the weekly chart, and that's when things can get ugly really quickly. Okay, now if we happen to open up somewhere where we are now, where we closed, and we get a pop maybe up into the 41.50 area, that might be an area to look for a short. Again, we're just going to have to play it by ear. It all depends on where we're going to open up on Monday. So again, if you guys are on Instagram, you can follow me over there. I'll post my thoughts, maybe not every day, but I'll try to post my thoughts as often as I can over there. And then if you guys also would like to see some of those YouTube shorts, let me know, and maybe I can post them on YouTube as well. All right, guys. Well, thanks a lot for tuning in. I hope you have a great weekend. Take care, and we'll see you in the next one.